Hey everyone, IDFC First has recently declared its Q3 results, and with this, company has completed its 5-year of guidance given during December 2018 at the time of merger of IDFC with Capital First to become IDFC First. So in this video, we'll first look at the Q3 results and try to understand the hits and misses. Then we'll look at the guidance given by management in December 18 and try to understand if management was able to meet those guidance or not. Most importantly, management has also given guidance for the next 5 years. So we'll have a look at it and try to decode its future growth potential. Alright, let's get started. Alright, let's first start with the Q3 performance of the bank. So if you look at loan and advances, it stood at 1.89 lakh crore and it's up by 24.5% year on year, which is a fantastic performance. If you look at customer deposits, it stood at 1.76 lakh crore and look at this, it's up by 42.8% year on year. So on both parameter of loan and advances and customer deposit, IDFC First has outperformed the peers by a big margin. Right? If you look at the diversification, its retail deposit is at 79% of your total customer deposit. CASA ratio stood at 46.8%. Overall asset quality of the bank, if you look at the gross NPA, it's 2.04% and net NPA is at 0.68%. So asset quality is also looking very good. And if you look at the asset quality at retail, rural and SME, it is even better at net NPA at 0.51. Now if you look at the 9 months of the performance for FY24, company's core operating income has grown at 34.7% year on year. Core operating profits have grown at 34.7%. Then profit after tax is up by 36.6%. Return on assets stood at 1.16 versus 1.05 and return on equity at 10.65 versus 9.95 and capital adequacy at 16.73. So all in all, it has been a fantastic performance on Q3 as well as for the 9 months of FY24, except that couple of factors like return on asset and return on equity are not up to the mark, which is where I think there is still a lot of scope for improvement, and that's what management has guided for the next 5 years. Let's drill down a bit further and try to understand the performance by looking at the quarterly income statement. So if you look at the interest income, it has grown at 33%. Interest expense are also up by 37%. So net if net interest income is up by 30%. Then operating income, if you calculate the other fees, is grown by 31%. So again, a very good performance. And if you look at the provisions have also grown by 45%. So this is the only part in its Q3 result which is not great. Whereas if you look at every other parameter, it's fantastic. The only problem is the provisions have also increased from 450 crore to 655 crore. Year on year. So that's a jump of 45% in provision, and that's where I think market did not like, and probably one of the reason why share price is corrected after result. There's another reason, I'll come to that. Apart from this, if you look at the profit after tax, it's grown at 18%. So the only reason why profit has not outgrown in spite of such a fantastic performance is because the provisions have increased by 45%, and that's the reason company's profit before tax is up only by 12%, and because of minus 7% tax, profit after tax is up by 18%. Now let's try to understand the long-term picture, how company has performed in last 5 years. Okay, so if you look at the customer deposit, look at this. Customer deposit in December 18 were 39,000 crore and now it is at 1.76 lakh crore. So that's 4.5 times growth in customer deposit. Look at the branches. There were 206 in December 18. Now it is at 897. So branch network has grown by 4.4 times in last 5 years. If you look at loan asset, it has grown from 1.404 lakh to 1.8. So the growth is 1.8 times. This is the only segment where the growth is not that great, mainly because company was actually, the last 5 year company utilized in building its liability side. You can see the management has mentioned that during the first 3 years after the merger, bank grew the loan book by only 5.1% CAGR to conserve resource and structurally improve the liability side. And that's where you can see the customer deposits have grown exponentially. Then if you look at the CASA, it has improved by 5 times. It was 8.7%, now it is at 46.8%. Then if you look at the pre-provision operating profit to average asset ratio, it was 0.8% and now it has increased to 2.3%. Again 2.9 times improvement, and its ROE has improved from 1.7% to 10.6%. So that's 6.2 times improvement. So the last 5 years of performance of IDFC First has been exceptional. And that is the reason I always say that try to look at the bigger picture. Don't just restrict yourself to quarter-on-quarter performance. because you don't get a clear picture when you just look at quarter on quarter. Try to look at the bigger picture. And this is one slide that I really like, the way bank has transformed. Look at this. In December 18, bank overall customer deposits stood at 38,455 crore, where the retail deposit was just about 27% and wholesale deposit was 73%. From there, look at this, the retail deposit has increased from 27% to your 59, 77 and all the way to 79%. And the wholesale deposit has reduced from 73% to just 21%. So the last 5 years, IDFC First has transformed itself from a wholesale bank to a retail focused bank. And this is an exceptional journey, and this is the reason I really have a strong faith in the leadership of the bank, Mr. V. Vaidyanathan. Let's first look at the other details as well. So if you look at the NPA journey of the bank, look at this. During this phase of 16, 17, 18, there were multiple issues in Indian banking system that resulted, demonetization, then GST, then ILFS crisis, that resulted in spike in the NPAs. Net NPAs, gross NPAs were in the range of 2%, net NPAs were in the range of 1 to 1.5. Then of course COVID happened, and due to that the NPA shoot up significantly. Gross stood at 4%, net stood at 1.9. But from there, look at this, your gross has reduced to 1.45 and net NPA stood at 0.5. So the asset quality has exceptionally improved over the last 4-5 years. Now, because of the outperformance in the business and the sharp improvement in asset quality, look at what has happened to the net profit. At this point in time, before COVID, it was just about 100 crore, and then during COVID, it resulted in sharp loss of 630 crore. But from there, look at the journey. It's been an exponential performance from 150, 200, 3, 5, 6, 7, and now it is at 700. Every quarter it is making that kind of profit, right? Again, there were multiple reasons. So you can see there were a lot of high provisions due to your Reliance Capital, DHFL, and a few other write-offs as well. So because of that, there were issues, but bank has outcome and it has outperformed big time. Then this slide gives a very good picture that explains the way bank has expanded its business, and today it is at 20 business lines. For that include your 28% mortgage backed loan, then 10% vehicle loan, 3% commercial vehicle, 11% rural finance, then consumer loan is at 14%, education loan 1%, credit card 3%, other retail loan 8%, and so on and so forth. And not only that, if you look at other income of the bank also, the fee and other income, it has also expanded. So it include your loan origination fee, then credit card and toll that stood at 18%, then there is trade and client forex, then you have got wealth management, third party distribution that stood at 16%, and there is general banking fee and other fee that is at 26%. So I hope you got a fair idea of the offerings of the bank. Now, because of all these development in the last few years, IDFC First has become a universal bank with entire product suite, right from retail lending solution to SME lending to CASA and fixed deposit, NRI banking, wealth management distribution, credit card, FASTag, trade finance, transaction banking and CMS, treasury and forex, supply chain financing, corporate lending. So maybe you want to spend some more time to understand the business in detail, but for sake of time, I just want to carry on. If you look at the credit rating, this is again a very important parameter for any bank, because credit rating agencies decide the rating, and that rating is very important for the bank to raise capital. And if there's an upgrade, that is a very positive sign, and that is what has happened. IDFC First credit rating has been recently upgraded by all three rating agencies, CARE, CRISIL and ICRA. CARE rating has upgraded from, this is for long-term credit rating, so AA stable to AA plus stable, then CRISIL AA stable to AA plus, ICRA AA stable to AA plus, and India rating AA plus negative to AA plus stable. So this is again a very, very positive sign. Now let's try to look at the bank's performance in last 5 years as compared to the guidance given by them. So on top you can see the various criteria, then at the time of merger in December 18 performance, then guidance for 2024-25, and what is the performance as of December 23 and the status. So first is capital. If you look at it, CET ratio was 16%, the guidance was to remain more than 12.5%, and December 23 is 13.95. So bank is on track, has achieved what it has mentioned. Capital adequacy, management guided for more than 13%. Today it is at 16.7%. Again achieved it and on track. Then if you look at the liability side, Management for the CASA mentioned that they want to be 30% for FY24 and 50% thereafter. And look at where they are today. 46.8% of CASA ratio, which is way above their guidance of 30%. So completely achieved it and on track. Then if you look at number of branches, they targeted 800 to 900 and they are at 897. Again achieved it. The next guidance was that the CASA plus term deposit of less than 5 crore. Which is the percentage of total deposit. Out of that, they wanted 85% of them to be below 5 crore, and they've achieved around 82%. So again, quite close to the target. Next, you have got certificate of deposit as percentage of total deposit and borrowing. They wanted it to be below 10% of liability. Again, at 3% achieved it. Then quarterly average LCR, they wanted it to be greater than 110%, currently at 121%, again on track. Then if you look at the asset side, the retail, rural and SME finance, the target was to achieve target of 1 lakh crore and today it is at 1.55 lakh crore. So big outperformance as compared to the target, more than 50% ahead of what they have targeted. Then if you look at rural, retail and SME finance as percentage of total loan and advances, they targeted it at 70%, today it is at 82%, again achieved it. Wholesale loan and advances, they wanted to be below 40,000, it is at 31,000, again achieved it. And of which infrastructure loan, they wanted to be nil in 5 years and now it is almost nil at just 3,000, so again on track. So all three parameters of capital, liability and asset, they are almost all the parameters they outperformed and achieved the target. Next two more parameters, which is asset quality and profitability. So they wanted top 10 borrowers as percentage of total loan advances to be below 5% and today it is at 2%, again achieved it. Gross NPA they targeted in the range of 2 to 2.5%, which is at 2.04, again achieved it. Net NPA they targeted between 1 to 1.2%, it is at 0.68, so outperform, again much better than what they have guided for. Provision coverage they were targeted at 70%, today it is at 85%, again achieved and on track. Next, if you look at the profitability, net interest margin they wanted in the range of 5 to 5.5% and it is at 6.36%. So again an outperformance on the net interest margin. The only factor where there is a concern is that these three things, where cost to income ratio they wanted it to be at 65%, which is currently at 72, so they are behind the schedule. And the return on asset, they actually wanted it in the range of 1.4 to 1.6%. It is at 1.16 and return on equity is between 13 to 15% they targeted and they guided for, and today it is at only 10.6. And so these are the only three factors in profitability that they could not achieve, or they're slightly behind the guidance. But apart from this, I think it has been a fantastic performance. Majority of parameter bank has outperformed. Now let's try to understand the target for FY29. So look at this. In the deposit, bank has given a target of earlier it was 206 in 18, then they increased it to 897, and for 2029 they are targeting the branches of around 1700 to 1800. So almost more than double or nearly double. Then if you look at the customer deposit, it is currently at 1.76 lakh crore, they are targeting at 5.85 lakh crore. So guidance at 5% CAGR would be around 25%. So basically they want the customer deposit to grow at 25%. So that's their guidance, right? Again, if you look at the year on year growth, it is at 42.8%. Then if you look at the CASA deposit, it is at 85,000. They want to be at 2.85 lakh crore, which is again around 24 to 25% of growth guidance against the year on year growth of 28.6%. Term deposit is at 90,000. They're targeting at 3 lakh crore. So that's a CAGR growth of 25% expected and against the growth of 59.4%. Now, if you look at the share price of the bank after the result, the share price has actually fallen around 7-8%, especially just after the result, the share price declined. And I think like one reason I said the provisions have increased, because of that the profitability reduced slightly. And the second reason is because probably street did not like the conservative growth guidance, because bank is growing at a very fast rate and the guidance management has given is not at par with the growth in the last few years. So this is probably, to do with the expectation versus what management has guided for. But in my opinion, 25% CAGR growth is a fantastic growth. You can see the kind of numbers you can achieve if you grow at 25% CAGR. Then if you look at the asset side, loan and advances stood at 1.89 lakh crore. The target is to reach 5 lakh crore. That is 20% CAGR growth against the previous growth of 24.5%. Total asset is at 2.7 lakh. They want to be at 7 lakh crore. Growth is again around 20%. So around 25% growth in the branches and your deposit side, and your 20% growth in the asset side, so which is basically the loans. So this is the guidance by management. And then if you look at the gross NPA, management is currently it is at 2%. They want it to be around 1.5%. And NPA, net NPA is at 0.68. They want it to be 0.4. And the major reason in my opinion why the guidance is not as high as the growth in the past is because management says that they want to keep a close eye on the NPA. They don't want to compromise on the asset quality just to grow, right? And that is a very fair approach in my opinion. Now, final piece, which is the profitability. Look at this. Profit for around December 23 is around 2,200 crore, and management is guiding for 12,000 to 13,000 kind of net profit, so which is around 6 to 7 times. And this is the logic is they want it to be at 1.9 to 2% of estimated return on asset of FY29. So if you look at the return on asset, currently it is at 1.2, and this is the aspect which I said management is lagging. They're targeting 1.9 to 2% return on asset, and they say that their model is naturally geared for 2% return on asset, and return on equity is at 10.7, and they've guided for 17 to 18% ROE. Again, the same logic, their model is naturally geared for 18% ROE. And based on these performance, management is giving a target of 12 to 13,000 crore of net profit in next 5 years. There was a recent interview of Mr. Vaidyanathan where he said that this is a conservative growth guidance. Please remember the guidance that management has given in last 5 years, they have outperformed on majority of parameter by a big margin. So it could possibly happen that in the next 5 years, they could outperform on a lot of parameter, if not all, right? So I'll strongly recommend you to watch this video on CNBC where you get a fair picture of management. And if you look at the share price again, in last 1 year, there was a sharp outperformance from lows of 50, nearly 100% return. Bank share touched levels of 100, but it's been nearly 5 months since the share has actually corrected 20%. Now it is up to you. What do you think? Whether it is an opportunity or not? So if you look at the valuation, stock P is at 18.5, price to book is 2, which in my opinion is very attractive. But at the end of the day, you need to decide whether you are a believer in bank's future prospect or not. And at the end of the day, it all depends upon the execution. And for that, you need a strong leadership, and that's where I have a strong faith on Mr. V. Vaidyanathan. Those of you who are not aware, he has been a veteran in the industry with more than 3 decades of experience. He started with Citibank in 90s. He was one of the board member at ICICI Group and helped ICICI Group set up the retail banking. Okay, and then he joined the Capital First and created huge wealth for the investors. And if you look at IDFC First, it's been a crazy turnaround in last 5 years. So ultimately, you got to decide whether you are a believer in his guidance or not. And that would help you decide whether you want to invest in the bank or not. In my opinion, I always say that I don't invest my money in a bank. I invest my money in a banker. And that's where I am keeping my faith in Mr. Vaidyanathan. Anyways, I'll keep a close eye on the result. I hope you got a fair picture of the performance in the last 5 years and the guidance for next 5 years. I hope this video will find you useful. And if you like it, do share it with your friends. I'll see you next video. Till then, take care.